Hello everyone. Today we are going to present chapter 4, and chapter 4 is about management fraud and audit risk. Okay, so I'll put this chapter in the context of other chapters. So we started chapter 1 with auditing and assurance service. And in this chapter we define what is meant by auditing and compare auditing with other service that the auditor provide. And then we moved in chapter 2 to professional standards. So, professional standards mainly focus on the guidelines that the auditor follow in the process of conducting the audit, and also the characteristics of the auditor and the principles that the auditor follow when preparing the audit report. And in chapter 12, we started to look at the different reports that the author provide, that the author produce, and this report is about the different opinions that the auditor give in the financial statement. We started with chapter 12 first because this is mainly the final output of the auditing process. And after that, we started again from scratch, from the beginning, by looking at the engagement planning. So which is the first process when the auditor starts the auditing process. So if we look at chapter 3, so in chapter 3, which is engagement planning, we started the first step that the auditor do, which is mainly about obtain or retain engagement. And after that, the auditor start to plan the auditing process, which mainly means that the auditor have audit plan, and this audit plan includes activities that the auditor plan to conduct during the audit process. And the next step is mainly to assess the risk. So which means that following the audit plan, the auditor start to identify the risk in the audit process. So what are the different risks that the auditor will face during the auditing process? And this is mainly before this step is before the auditor start to collect evidence and then prepare the report. So we are now in the process of risk assessment. So chapter 4 is about management fraud and audit risk, and this is mainly part of the risk assessment. So what are the learning objectives in this chapter? So the first learning objective in this chapter is mainly to define what is meant by audit risk. Okay, and then describe the different components of the audit risk. And the main purpose here is to help the auditor in assessing and responding to this risk during the audit planning process. So which means that the auditor prepare themselves to what they are going to face during the auditing process. And then we, in the second objective, we would like to explain what is the auditor responsibility for fraud risk. Okay, because we have what is called error and fraud. Okay, so and the fraud is mainly severe case. So whether the auditor is mainly responsible for the fraud discovery or not. Okay, so this is mainly about assessing the responsibility of the auditor, and explain the differences between different types of fraud and error that might occur in an organization. Okay, so we'll see the different definition here and try to differentiate between the different types of audit fraud, fraud and errors. And the third objective, explain the audit responsibility to assess inherent risk. So this is merely one of the components of the audit risk. Audit risk mainly consists of three different components. The first one is mainly called inherent risk. The second one is control risk, and the third one is detection risk. So we'll start here to look at the first type of audit risk, which is mainly inherent risk, or the first component which is inherent risk, and include description of the type of risk assessment procedure that should be performed when assessing inherent risk on an audit engagement. So in this case, we'll see how the auditor assess the inherent risk. And in the objective number 4, we need to identify the different sources of information that the auditor rely on, and the audit procedure used by the auditor when assessing the risk. And the different audit procedure here include analytical procedure, brainstorming, and inquiry. So this is mainly how the auditor collect the information about audit risk, especially inherent risk, and then explain how auditor complete and document the overall assessment of inherent risk. Because without documenting, so the auditor will not able to present their evidence, so they will not be able to prove what they did. And then explain auditor responsibility with respect to a client failure to comply with laws and regulations. So this is really about compliance with laws and regulations, and the responsibility of the auditor about this specific kind of compliance. And the final objective describe the content and purpose of an audit strategy memorandum, so which is mainly after the auditor mainly assess the risk. So in this case, they mainly develop an audit strategy to explain the different steps, the different procedures that the auditor should follow to mainly mitigate or reduce the risk assessed. So starting here with the definition of audit risk. So audit risk is the risk that the auditor will express an inappropriate audit opinion when the financial statements are materially misstated, which means that the auditor give an modified opinion on financial statements that are misleading because of material misstatement the auditor failed to discover. So this mainly means that the auditor here is not able to discover material misstatement. So material misstatement is this terminology about misstatements. This is mainly referred to both error and fraud. So when we call misstatement, this is mainly referred to error and fraud. And error and fraud should be material. Okay. So, and the concept of materiality here, we explained it before. So what is material? What is immaterial? So materiality here is from the point of view of the users of financial statements. So the user of financial statements make decision based on financial statement. So they may use financial information to make their decision. So the information that is material, this is the information that influence their decision. Influencing their decision means this information will change their opinion, which means here the author, for example, so if the information is material, this means that the information will change their opinion. And changing their opinion, like for example, if the user is investor, whether the investor invests in the company or not. Okay, So in this case, it means that if the information here is material, so it will make the user make either correct decision or wrong decision. So depending on whether the information is mainly materially misstated or correct information. Okay, so audit risk can be broken down, which is mainly the component of the audit risk, into three different types of risk. So the first type is mainly called inherent risk, and the second type is called control risk, and the third type is detection risk. So inherent risk, this is mainly a material misstatement will even occur. So which means that there might be error or fraud, and this error or fraud will occur. Okay, so for example, cash has inherent risk because cash is liquid assets and can be easily stolen if not protected. Okay, so in this case, it has material misstatement, so it can be stolen, so it can have error or fraud. Okay, and this may be called inherent. Inherent, it means it has a characteristic that attract people to steal it. The second type of risk is mainly called control risk. Control risk, this means that the material misstatement would not be prevented or detected by client internal controls. So internal controls, this mainly procedure used by the client, which is mainly the company, to prevent or detect material misstatement. So for example, if the item that we look at cash, and the cash has inherent risk, which is mainly can be stolen, so the client, the company, has an obligation to protect cash. So for example, some of the internal control system, so it means include mainly the cash received during the day should be deposited in the bank on a regular basis, which means reduce the liquid cash available in the company. So this means to protect the cash from being stolen, and any payment should be made through the bank, okay, which is mainly using checks. So this mainly is the second type of risk, audit risk, which is mainly control risk, and the third type is detection risk, which is means also that a material misstatement is not detected by the auditor's own procedure. So which is mainly the auditor will fail to discover error or fraud. So for example, the cash stolen, and because there is a weak internal control system, so the cash is not deposited on regular basis in the bank account. So the auditor obligation here is the auditor responsibility is to discover whether the cash is stolen or not. So if the auditor procedure is not able to discover whether the cash is stolen or not, so there is a failure in the audit procedure, which is mainly called detection risk. So these three types of risk are the component of audit risk. They are interrelated here. So we have inherent risk, which is mainly the likelihood that an error or fraud will enter the accounting information system. The second type is the control risk, the likelihood that an error or fraud will not be prevented or detected by the client internal control. And both type of risk, which is mainly inherent risk and control risk, are called the risk of material misstatement. Okay, so this is mainly the two types, which is mainly error and fraud in the accounting system. they are called together as the risk of material misstatement. And then it comes to the light is the audit procedure. So if the system of the company is weak, so the auditor need to identify these weaknesses. Okay, so the detection risk is the likelihood that an error or fraud will not be quoted by the auditor procedure. So which means that the auditor use either inappropriate procedure or wrong procedure and is not able to discover the weaknesses in the accounting system. And the three components of the audit risk mainly lead to the final outcome, which is mainly the likelihood that an error or fraud will occur and not be caught by either internal control or auditor procedure. So this mainly the final outcome of the three components of the audit risk. So moving now to the control risk. And the control risk is, as a definition, is the likelihood that the client internal control policies and procedure fail to prevent or detect a material misstatement. Okay, so which means that the internal control system, the procedure that the client is a company for used to protect their assets and resources mainly fail to protect them. Factors affecting control risk include the environment in which the company operates, which is mainly called the control environment, the existence or lack thereof, and the effectiveness of control activities and monitoring activities, which is mainly include audit committee, internal audit function, and other monitoring activity within the organization. Okay, so we will have a separate chapter that explain the internal control system and how the system can be designed to protect the resources used by the company. And the detection risk, this mainly the likelihood that the auditor substantive procedure will fail to detect a material misstatement that exists within an account balance or class of transaction. And this mainly the failure of the auditor procedure. And there are some factors affecting the detection risk, which mainly it can reduce or increase the detection risk. And this is mainly about the nature, timing, and extent of audit procedure. So this mainly the audit procedure that the auditor used to collect evidence. Okay, so the nature of the procedure and the timing, which is mainly during the year or at the end of the year, and the extent, so the sample size. Also, we have what is called sampling risk. And this mainly sampling risk, you might remember this type of risk in a statistics course. Okay, and this means the risk of choosing an unrepresentative sample. So if the sample is mainly chosen is mainly a wrong sample, it doesn't represent the population. So in this case, there is a sampling risk. And also we have what is called non-sampling risk. So if even the sample is correct, but the auditor here may use wrong procedure to collect the evidence. So there is a risk that the auditor may reach inappropriate conclusions based on available evidence. So this may misjudgment. Okay. So this equation is mainly called the audit risk model. Okay, audit risk model is mainly audit risk equal inherent risk multiplied by control risk multiplied by detection risk. And as you see in this model, so the first two components, which is inherent risk and control risk, they together called risk of material misstatement, and the role of the auditor is merely to assess these two types of risk. Okay, because based on assessing this risk, whether they are high or low, so the auditor will calculate the detection risk, and the auditor need to control to reduce the detection risk to an acceptable level. Okay, so audit risk can be low or very low. So it should be low or very low. So which in total it is the outcome of the three other type of risk. We have inherent risk. If it is high, okay, it means that material misstatement is likely to enter the accounting information system, so there might error or fraud happen. So this should be prevented. Okay, so and the main mechanism to prevent the inherent risk or reduce or mitigate the inherent risk is to use appropriate internal control procedure by the company. But in this case, we might face another failure, which is merely the failure of the internal control procedure. Okay, so the internal control system may fail to prevent or detect an error or fraud that enter into the accounting system. So if the control risk is high, which means that the material misstatement is not likely to be detected by the client internal control, so this means the internal control system is weak. So in this case, there is a role for the auditor to discover or detect the error or fraud that is not detected or prevented by the internal control procedure. So we now moving to detection risk. And detection risk, what is the acceptable level of detection risk? So we have two cases here. Detection risk can be high or low. So high means that we can afford less effective testing. Less effective testing means that the auditor here accept a high level of detection risk, which is merely high failure of the auditor procedure. And this case can happen because the internal control system, if the internal control system of the client is effective, which is merely is able to discover most of the error or fraud that enter into the accounting system. So in this case, the auditor will use less effective testing. Detection risk should be low, means that we need more effective testing. So this case, when the internal control system is of the client is less effective. Okay, so in this case, the auditor need to compensate the failure of the internal control system by using more effective audit procedure. So we'll see here in this table what low detection risk mean and what high detection risk mean in terms of the impact on nature, timing, and extent of audit procedure. If the auditor would like to accept low level of detection risk, so in this case, it means that the auditor need to collect more evidence and use more effective audit test. So in terms of the nature of the audit procedure, it should be more effective test. In terms of the timing, so when the auditor conduct this audit procedure, it should be around the year end. Okay, and in terms of the extent, this is about the sample. So it should be a large sample. So it is more test, which is mainly testing more items. If the author would like to accept high level of detection risk, so it means here in terms of nature, timing, and extent of audit procedure. So the author will conduct less effective test, and the timing of this test can be at interim. Interim, it is mainly during the accounting period. It is not at the end of the accounting period, so it is at any time during the year. And in terms of the sample that the author use, it should be fewer tests. Fewer tests is mainly a small sample or a smaller sample. Audit risk can be quantified. So it means it can be converted into numbers rather than qualitative, low, high, moderate. So it can be quantified as percentage. Okay. And the author here, when the author plan it, so the author need to identify the relation here between inherent risk and control risk, and the author choose the appropriate level of detection risk based on the level of both inherent risk and control risk. So it can be high, moderate, so low, moderate, high, depending on this relation between inherent risk and control risk. Moving to fraud risk and the definition of fraud. Fraud risk is a special case of the risk of material misstatement, which is mainly one of the different types of material risk, and this mainly relates to situation where management intended to mislead the marketplace by issuing fraudulent financial statements. So there is intention on the part of the management to deceive the marketplace, which is mainly the users of financial statement, by issuing a fraudulent financial statement, which is mainly means misleading information. So give mislead information to the users, and the misstatement here may be caused by an error or a fraud. So, and the difference between error and fraud is mainly the intention. So whether it is by mistake or by intention. We have the definition of fraud here. Fraud is the act of knowingly making material misrepresentations of fact. So there is here an intention to mislead, okay, because it is knowingly. So the management know that they provide false information with the intent of inducing someone to believe the falsehood and act on it, which is merely try to convince the users of financial statement that the false information is true, okay, and act on it, which means that they use this information in making their decisions. And in this case, if they use the wrong information, so they will reach to wrong conclusion and wrong decision and suffer a loss or damage. So, for example, investor invest in the company and the company liquidate. So they will lose their investment in the company. So they will suffer a loss or damage. So we have here factors affecting the fraud risk. We have three factors that might indicate increased risk of fraudulent financial reporting. So these factors can increase or decrease the likelihood of fraud risk. So the first factor is management characteristics and influence, and the second one is industry conditions, and the third one operating characteristics and financial stability. So we have examples here of these factors. So for example, management characteristics and influence. Management has a motivation like bonus, compensation, stock options to engage in fraudulent reporting. So for example, if the compensation of the management is linked to the profit, for example, top management will get 10% of the profit. So this means that the management has a motivation to increase the profit, to increase their compensation, because the higher the profit level, the higher the compensation. So in this case, they have a motivation to report on higher level of profit, whether this higher level of profit is actual or not. Another example about industry conditions. For example, the company industry is declining. So there is here bad conditions in the industry, and the industry is declining. So there is a motivation here to produce financial statements that reflect that the company is surviving and the company is able to compete in this industry. So it also gives the management of the company a motivation to provide false information. In regard to operating characteristics and financial stability, so there are several factors here that is mainly within the organization. So like a weak internal control environment prevails, which means the company doesn't protect its resources, so they don't use a strong internal control system to prevent error or fraud from happening. Fraud can happen in all parts of the organization and can affect all the stakeholders like customers, government, insurers, employees, vendors, suppliers, consultants, competitors, stockholders, creditors, owners, and managers. Okay, so for example, for government, so there is tax evasion, which means that the company has a motivation to reduce the payment of tax to the government. So they may change the accounting figures to reduce the profit and therefore reduce the tax paid to the government, so they can avoid paying the high level of tax. We have also other definitions related to fraud. So we mainly define fraud as the act of knowingly making material misrepresentation of fact with the intent of inducing someone to believe the falsehood and act on it, and thus suffer a loss or damage. So this merely intentional misstatement. Errors is mainly different from fraud because it is unintentional misstatement. Okay. Or omissions of amounts or disclosure in financial statements. So this mainly unintentional, but the fraud is intentional. So errors are not considered fraud because they occur unintentionally, while acts of fraud are intentional. So we have other definition of fraud, like employee fraud, which is mainly the use of fraudulent means to misappropriate funds or other property from an employer. So this may differ from management fraud because management fraud is comprehensive, more comprehensive, affect the whole organization, but employee fraud is mainly narrow in terms of the scale. Okay, so the employee has a fund or other property, and this mainly they can misappropriate this fund or other property to mainly gain advantage. So for example, they can steal the money from their employee or misuse the resources allocated to them. We have also embezzlement, which is a type of fraud involving employees or non-employees wrongfully misappropriating a fund or property entrusted to their care, custody, and control, and often are combined by false accounting entries and other forms of deception and cover-up. So mainly this embezzlement is similar to the employee fraud in terms of they affect the fund or property, but it is combined by false account entry and other form of deception and cover up. So they try to cover up the error, the fraud that happened. Larceny is simple theft. So for example, an employee misappropriate an employer fund or property that have not been entrusted to the custody of the employees. So this is mainly different from embezzlement because the fund or property here is not in their own custody. So in this case, it is in the custody of other employees, so they can steal it. So they can it is simple theft. So deflection is another name for employee fraud, embezzlement, and larceny, and it is also called misappropriation of assets. So this three terminology, which is employee fraud, embezzlement, and larceny, can be called deflection or can be called a misappropriation of assets. Moving now to inherent risk and the assessment of inherent risk. So, which is mainly the first component of the audit risk. Risk assessment is mainly a part of the audit process. It can happen at the level of the overall financial statement or at the level of assertions. Okay, which is mainly related to different items in financial statements. So inherent risk here, as a definition, refer to the exposure of suspectability of an assertion within an entity's financial statement to a material misstatement without regard to the system of internal control. So it is related to the exposure of one of the assertions to a misstatement, and this misstatement is material in the absence of the internal control system. If there is no protection provided, so the assets or the assertion here related to a specific asset or liability or equity, so will be subjected to a misstatement. So we have examples here of different types of misstatements, like for example, invalid transaction are recorded, or valid transaction or disclosure are omitted, transaction or disclosure are inaccurate, transaction are classified in the wrong account, transaction accounting and posting are incorrect, transaction are recorded in the wrong period. So there's many different types of error. It can be error or fraud, so it can depend on the intention here and the related here assertion to this error or fraud. So we're moving now to the process of assessing the risk, especially inherent risk. And this process here starts with understanding the company and its environment. We have here industry and external factors. So this mainly outside the organization. Accounting principle and disclosure. This is related to each industry. And then the nature of the company. This is related to the company and its objectives and strategy. And then measurement and analysis of financial performance. So the author uses this information here to understand the company and its environment. And once the auditor here may get an overall view about the industry and the company, so the auditor moves to understanding the internal control procedure. And the focus here on internal control over financial reporting, because there are different types of internal control. So the author focus on internal control in relation to financial reporting, in relation to the financial statement. And then the author here collect information from client acceptance and retention evaluation, audit planning, post audit, and other engagements. So this mainly other sources of information. And this information here is mainly collected here using these techniques. So this procedure. So we have perform analytical procedure, which is mainly analyzing financial statements. We have also brainstorming. We have inquire of audit committee, management, and others. So based on all this information, the author here could assess the risk, especially inherent risk. And then after assessing the risk, identifying whether the level of risk is high or moderate or low. So the author needs to respond to this risk. So how the author will audit the financial statement, whether the auditor will use more or less effective testing. So it can be more effective substantive procedure or procedure closer to the year end, use of a specialist or experienced personnel, and then communicate the result about reporting about the error or fraud that the auditor discovered. So what makes internal inherent risk high or low? Okay, we have different factors that affect the susceptibility of accounts to misstatement or fraud. We have high dollar size of account, liquidity, volume of transactions, complexity of transactions, subjective estimates. So these factors increase the likelihood of inherent risk, increasing the inherent risk. Dollar size of account, so the larger amount in the account, so the more the inherent risk. Liquidity also, liquid items like cash will have more inherent risk than the other items like building equipment, machines. So this mainly is not liquid. Okay, so they will have less inherent risk. Volume of transactions, so the higher the level of transactions, so the higher of the volume of the transactions, so the more the inherent risk. The complexity of the transactions, so if the transactions are complex, like financial instruments or like leasing, so in this case, in this type of transactions, so there will be more inherent risk. Subjective estimates, so if the items need more subjective estimates, like for example the life of machines or equipment, so whether the life is 10 years, 20 years, 50 years, so this many subjective estimates, so the more the inherent risk. Okay, understanding the client business and its environment. So the author here, this mainly is the first step when the author starts the assessment of the inherent risk, which is about understanding the client business and its environment. So the author needs to gain a detailed understanding and knowledge of the client business and its environment. Okay, so the author needs to collect information about the industry, regulatory, and other external factors, nature of the company and the related parties, the effect of client computerized processing, also accounting principles and risk disclosure, the company objectives and strategy, and at the same time related business risk and company performance and measure and analysis. So the source of information that the author needs to collect about to understand the client and its environment. We have general business sources, we have company sources, and information here from other sources like client acceptance or continuous evaluation, audit planning, post audit, and other engagement. So general business sources like trade magazine and journal, general business magazine and newspaper. So this may be published in different countries. Company sources, this mainly from within the organization, that like corporate charter and bylaws or partnership agreements, this mainly contract agreements and the legal proceeding, minutes of meetings of directors and committees of the board of directors. So this mainly sources from within the organization. Also, the author can use analytical procedure to collect evidence, collect information about the company and try to assess the risk. So we have analytical procedure. So the analytical procedure here is mainly used to estimate the account balance. So like liquidity ratios, for example, current ratio. So it can be used to estimate the cash, for example. So we have recorded account, and this may compare to estimated account balance. So this may be based on financial ratios, and the other one is the actual one. And the main purpose of using preliminary analytical procedure is to identify potential problem areas, so which is mainly called attention directing. So it is mainly direct the attention of the auditor to potential areas. So potential areas that have error or fraud. So when we have a gap between estimated balance and actual balance. So we have here it is organized approach to start examine the financial statement, describe financial activity, identify unusual change in relation in the data by estimating account balance and compare it to the actual balance, so the author can discover unusual change in relation. So like the relation between cost of goods sold and the sales, for example. So there is a relation. Okay, so like profit margin, so whether the profit margin is less than the industry average or not. Okay, so the author here can discover unusual changes and in unusual relation. When the author discover any gap, so in this case the author will ask what could be wrong, what legitimate reasons are there for this result, and another source here is to cash flow analysis, to analyze cash flow statement and to identify any changes in the cash. Steps for performing analytical procedure: develop an expectation, define a significant difference, comparing expectation with the recorded amount, investigate significant difference, and document each of the preceding procedure. So this mainly the different steps that the author follow. We know that the analytical procedure can be used in different stages. So at the planning stage, okay, it is required by auditing standards, and the main purpose of using analytical procedure here is to test reasonableness, whether the estimates, the actual amount in the account is mainly reasonable in terms of the estimated value. So compare between the actual and estimated values and identify the gap. So whether the cash balance, for example, if the author estimated cash balance, whether the estimated cash balance is reasonable in terms of its relation to the actual balance. The analytical procedure also is a requirement at the end of the audit process, but it is optional during the auditing process. So these three stages in planning, during, and at the end. So in the planning, at the beginning and at the end, the use of analytical procedure are requirements, are must to be used, but during the audit process, it is optional to collect evidence. Another technique that the author used to assess the risk is mainly called brainstorming. And brainstorming, the main purpose of using brainstorming is to understand and the understanding here is related to previous experience with client and how a fraud might be perpetrated, which is mainly occurred and concealed in the entity. And procedure also can be used to detect fraud. So brainstorming is mainly a discussion, and this discussion, it is mainly between the audit team. So the audit team discuss the issues that they face in the auditing of a client, and also compare it to the industry, so based on their experience. So this discussion can help identify the issues in a specific engagement. Okay. Another technique as well is inquiries, which is mainly interviews, and these interviews can happen with can be conducted with client personnel and groups like management, internal auditors, directors, audit committee, and other employees. And the main purpose here also to collect information about the company and its industry to assess the inherent risk. After assessing the risk using different techniques that we refer to, so the author need to document the inherent risk. Okay, and documenting here is important part in the process because it mainly gives the author an evidence that they mainly perform the audit in due care. In terms of what can go wrong, which is mainly related to the inherent risk, so we can here differentiate between significant account and relevant assertions. So significant account and relevant assertion. Significant accounts, this means the accounts that there is a high probability that will be subjected to error or fraud. And relevant assertion also, this is mainly the assertions that is related to specific account that have a high probability to be subjected to fraud or error. So for example, cash is one of the accounts that can be subjected to error or fraud, and the related assertions to cash: existence, valuation, presentation, and disclosure. And existence is the most important assertion, whether the cash balance exists in the company account or not, because the cash can be stolen easily. And also account receivable, it has also relevant assertion like existence, completeness, and valuation. And the most important assertion for account receivable is existence, whether the account receivable balance are inflated and doesn't really exist. So this is also an important issue that the auditor need to consider when they audit these specific accounts. When the auditor assess the risk, so the auditor needs to look at the type of the risk, the significance of the risk, whether the risk is material or immaterial, likelihood of the risk, whether the risk is regular or irregular, pervasiveness of the risk, whether the risk affects a specific item or the whole financial statements, assess controls and programs, so which means that the auditor need to look at internal control system and whether the company has a strong or weak system. How the auditor respond to the assess risk. So responding to the risk, especially significant risk, by assignment of personnel, which is mainly use more experienced personnel, the choice of accounting principle, predictability of audit procedure, a retrospective review of prior year accounting estimates. So this mainly all the response here if the assessed risk is high, accumulated result of procedure and extended procedure. And the auditor here need to evaluate audit evidence when they assess the risk, to search for discrepancies in the accounting record, conflicting or misleading evidential matter, problematic or unusual relation between the auditor and management, a result from review of the final stage of substantive analytical procedure, vague, implausible or inconsistent responses to inquiries, and then document the risk, and documenting here to provide a record of the procedure performed, and items that must be documented. So what the auditor need to document, what the auditor need to provide a record of. A discussion with engagement personnel like management, like audit committee, procedure to identify and assess risk, significant decision during discussion, whether the auditor accept or reject the level of risk, specific risk identified and audit team responses, explanation of why improper revenue recognition is not a risk, result of audit procedure, particularly procedure related regarding management override, other condition causing auditor to believe that additional procedure are required, communication with management and those with governance such as the audit committee. We have also fraud and other significant risk. One of the area that is subject to the risk is improper revenue recognition, which is mainly the timing in which the company recognizes the revenue. And the rule here for accounting is revenue should be recognized at the delivery point. But the companies can mainly delay or accelerate the revenue recognition depending on the intention here, whether to increase the profit or decrease the profit. So identify risk of management override of control, and this may be one of the areas that need careful attention because the top management can ignore part of the internal control system. So they can mainly change the procedure by their decision. So for example, depositing the cash at the end of each day. So the top management can require the employees not to follow this procedure. So ignoring depositing the cash at the end of the year, the day. Examine journal entries and other adjustments, review account estimates for biases, evaluate business rationale for significant unusual transactions. And also the author need to identify significant risk. A communication of fraud risk. So if the auditor discover fraud, so what the auditor should do, to which level they should report this fraud to. So the rule here, the auditor must always exercise significant care, because acquisition of fraud are taken very seriously by audit clients. Okay, and evidence that fraud may exist must be communicated to appropriate level of management, usually at least one level above the people involved. So for example, if fraud discovered at the low level of management, so the communication it should be to the middle level of management. If the fraud at the middle level, it should be communicated to the top level of management. If the fraud at the top level of management, so in this case the auditor need to communicate to the board of directors. So this mainly different levels at which the auditor need to report. Any fraud committed by management, no matter how small, and management here refer to top management, is material and should be reported to those charged with governance, usually the audit committee or board of directors. Moving to the issue about compliance with laws and regulation, and this is also part of the assessment of inherent risk, the issue here about non-compliance with laws and regulation. So when the company doesn't obey, doesn't follow laws and regulation. Okay, so we have different type of risk related to non-compliance with laws and regulation. So the first type is mainly called direct effect non-compliance, and we have the second type is mainly called indirect effect. Indirect is mainly in relation to financial statements. So the first type, direct effect non-compliance, produce direct and material effects on financial statements, which is mainly directly affecting a specific account or disclosure, like for example income tax evasion. So what is the author responsibility for direct effect non-compliance? The responsibility of the author here is to design procedure to provide reasonable assurance, because in all cases the author provide reasonable assurance. So in this case, if the non-compliance with laws and regulation has direct impact on financial statement, which affecting specific accounts and financial statements, so in this case the author need to design a procedure to discover this non-compliance. If the non-compliance has indirect effect, which is mainly not related to specific accounts or disclosure in the financial statements, so example here like violation related to insider security trading or occupational health and safety, food and drug admission, environmental protection, equal opportunity, employment opportunity. So in this case the author responsibility here is less. Okay, follow up on suspected violation material to the financial statement. So the author need to follow up this non-compliance, which has indirect effect on financial statement until it become indirect in relation to financial statements. So for example, violation to environmental protection. So this is mainly in one stage can have direct impact on financial statements. Once the issue become direct in relation to financial statements, the author need to design procedure to discover any error or fraud. But if it doesn't have direct effect on financial statements, so in this case the author just following up until it become direct in relation to financial statement. We have some indications of non-compliance, like investigations, fines or penalties, payments for unspecified service or loans, excessive sales commission or agent fees, purchase significantly above or below market, unusual payment in cash, unusual transaction with companies in tax havens, payment to countries other than the organization, inadequate audit trail, unauthorized or improperly recorded transaction, media content, non-compliance cited in the report of examination, failure to file tax return or pay government duties or fees. Moving to the final topic here in this chapter is about developing audit strategy, and the author here need to develop audit strategy based on the risk assessed, and the audit strategy here is mainly focusing on scope, timing, and direction for auditing, and this is mainly relevant to each assertion. And this may result from the audit risk model. So it is mainly after identifying or assessing the risk, the author need to produce a strategy to identify or to collect evidence. So in establishing the overall audit strategy, the author need to consider the reporting objectives of the engagement and the nature of the communication required, the factors that are significant in directing the activity of the engagement team, the result of preliminary engagement activity, and the auditor assessment of risk. Also, various laws and regulations may require other matter to be communicated. The audit strategy identifies significant account and disclosure, establish overall audit strategy for each relevant assertion, and also nature, timing, and extent of necessary resources, plan test of controls, and also written audit plan documenting audit strategy is required. So this is many example of the audit strategy. Like here for overall, this audit strategy is intended to provide our response to the risk identified for integrated and generally detailed the associated test of control and substantive procedures that will be required during the audit. So once the author identifies the risk, so the author need to develop responses to this risk. So for example, risk here, which is mainly revenue recognition related to the participation in Medicare and Medicaid program. Okay, this is related to the revenue and collection cycle. So we have assertion here, and we have test of control and substantive procedure. So test of control is made to test whether the internal control system related to revenue recognition is effective or ineffective, and then a substantive procedure is mainly related to the auditor collecting evidence about the revenue recognition. So this is mainly what we need to present in this chapter, and we'll stop at this point today. Thank you very much.